Robotics is no longer some far-off sci-fi idea. It's not just robots in factories or futuristic humanoids walking around. Right now, the biggest and most powerful robotics revolution is happening quietly inside hospitals, operating rooms, and medical labs. And most retail investors are still sleeping on it. Today on Stockora, we're talking about why healthcare robotics could be the next massive investment wave and how a few companies are already positioning themselves to dominate this space before the crowd fully realizes what's happening. Before we dive in, let me ask you something. What if the next trillion-dollar tech boom isn't happening in social media, smartphones, or even AI software, but in robotic systems that literally save lives? Systems that doctors depend on every single day. Systems that hospitals can't operate without once they adopt them. That's the kind of opportunity smart money looks for early, and that's exactly what we're breaking down today. If you're serious about staying ahead of market trends, make sure you subscribe to Stockora right now. We break down the biggest investing themes in simple language, without hype, without noise, and with a focus on long-term wealth. Subscribing helps the channel grow, and it helps you stay one step ahead of the market. Now, a lot of people think robotics equals Tesla, humanoid robots, and futuristic automation. And yes, Tesla's Optimus robot has definitely brought a lot of attention to the robotics conversation. Every time Tesla reports earnings, investors want updates on how far humanoid robots have come. But here's the key point most investors miss. The real money in robotics right now isn't in experimental humanoids, it's in healthcare robotics, where the technology is already proven, already generating revenue, and already deeply embedded into real-world systems. Healthcare robotics looks very different from what you see in movies. It's not flashy, it's precise, it's controlled, and most importantly, it's essential. These are robotic systems that assist surgeons, improve patient outcomes, reduce recovery time, and allow hospitals to perform complex procedures more efficiently. Once a hospital adopts these systems, they don't go back. And that creates something investors absolutely love: recurring revenue. The first company we're talking about today is the undisputed leader in robotic-assisted surgery. Even if you don't follow medical technology closely, there's a very high chance you've heard of their system, Intuitive Surgical. Ticker symbol ISRG. Intuitive Surgical is the company behind the Da Vinci surgical system, which has become the gold standard in robotic-assisted surgery worldwide. Hospitals across the globe rely on Da Vinci systems to perform minimally invasive procedures with incredible precision. Surgeons don't just use these robots occasionally, they depend on them. And that dependency is the foundation of Intuitive Surgical's powerful business model. Here's what makes this company so special from an investment standpoint. Intuitive Surgical operates on what's known as a razor and blade model. Hospitals make a large upfront purchase when they buy the Da Vinci system. That's a solid revenue boost. But that's not where the real money is made. The real profits come later. Every single surgery performed using the Da Vinci system requires specialized instruments, accessories, maintenance, and service contracts that only Intuitive Surgical provides. That means every procedure generates recurring revenue. As the number of surgeries increases, revenue increases. As revenue increases, margins expand. And as margins expand, profits grow. This isn't a one-time sale business. It's a long-term, compounding revenue machine. Now, some investors look at Intuitive Surgical and say, the stock looks expensive. And yes, the price-to-earnings ratio is higher than average. But price alone doesn't tell the full story. You're not paying for a cyclical business. You're paying for market dominance, high switching costs, recurring revenue, and a massive technological moat that competitors struggle to replicate. Over the past 5 years, Intuitive Surgical has delivered impressive long-term performance, even though the stock hasn't moved in a straight line. There have been pullbacks, there have been periods of consolidation, but the overall trend remains strong. And here's something else investors should pay attention to. Institutional ownership in this stock is extremely high, while short interest remains very low. That tells you big money believes in the long-term story. Analysts are also largely bullish. Consensus price targets suggest meaningful upside from current levels, and several major firms have issued even higher targets, pointing to confidence in future growth. When analysts look at Intuitive Surgical, they're not just valuing current earnings, they're valuing the future expansion of robotic surgery worldwide. And here's the big question investors ask: is it still early? The answer is yes. Robotic assisted surgery is still in the early to middle innings globally. Many hospitals haven't adopted these systems yet. Many procedures are still transitioning from traditional methods to robotic assistance. And as populations age, the demand for safer, minimally invasive surgeries will only increase. This is exactly the kind of company that benefits from long-term demographic trends, not short-term market noise. And that's why Intuitive Surgical continues to be one of the most important healthcare robotic stocks to watch. Now, before we move on to the next company, let me know in the comments. Would you personally invest in a market leader like Intuitive Surgical, or do you prefer looking for under-the-radar opportunities with more risk and more upside? Drop your thoughts below, and don't forget to like and share this video if you're finding value so far. It really helps Stockora reach more investors like you. The second company we're talking about today takes a very different approach to healthcare robotics. Instead of being a pure-play robotics company, this one is a diversified medical technology giant that's slowly but strategically expanding its robotic footprint. The company is Medtronic, ticker symbol MDT. Medtronic is a name many investors already recognize. It operates across multiple areas of healthcare, including cardiac devices, diabetes management, neuroscience, and surgical technologies. And while robotics is not its only focus, it's becoming an increasingly important part of its future strategy. Medtronic's robotic surgery platform is called Hugo. It's designed as a modular and more flexible alternative to traditional robotic systems. Unlike some standalone platforms, Hugo allows hospitals to adapt the system more easily to different operating room setups. This flexibility could be especially appealing to hospitals that already have long-standing relationships with Medtronic across other medical device categories. That's where Medtronic's real advantage lies. Hospitals that already trust Medtronic for cardiac devices or diabetes technology may be more willing to adopt its robotic systems as well. Medtronic can bundle services, offer integrated solutions, and play the long game. And with a massive balance sheet and deep regulatory expertise, it has the resources to slowly gain market share over time. From a stock perspective, Medtronic looks very different from Intuitive Surgical. It's less volatile, it's more stable, and it pays a dividend. Investors looking for income and lower risk may find Medtronic appealing, even if it doesn't offer the same explosive growth potential as a pure robotics leader. It's a classic risk-reward trade-off. Now let's talk about the third and final company on today's list, and this one focuses on a completely different side of healthcare robotics: Edwards Lifesciences, ticker symbol EW. Edwards Lifesciences is the global leader in structural heart therapies. Its flagship innovation is a minimally invasive procedure known as transcatheter aortic valve replacement, or TAVR. Instead of open heart surgery, doctors can replace a diseased valve by threading a new one through an artery. This dramatically reduces recovery time and improves patient outcomes. What makes this so powerful is how the market has expanded over time. Initially, TAVR was only approved for high-risk patients, but as clinical data improved, approvals expanded to intermediate risk and even low-risk patients. That massively increased the total addressable market for Edwards Lifesciences, and the company isn't standing still. It's investing heavily in next-generation valve platforms that are easier to implant, more durable, and suitable for a wider range of patients. With aging populations and rising cardiovascular disease, demand for these procedures is expected to grow for years. Analysts see this clearly. Price targets suggest solid upside, and many believe Edwards Lifesciences is still early in its growth cycle despite already being a market leader. This is another example of robotics quietly transforming healthcare in a way that's sustainable and profitable. When you step back and look at the big picture, a clear pattern emerges. The companies best positioned to win in healthcare robotics aren't startups burning cash. They're established leaders with proven technology, strong balance sheets, and deep relationships with hospitals. These are the companies that can invest through downturns, acquire smaller innovators, and bring cutting-edge solutions to market faster. That's why healthcare robotics is such a compelling investment theme. It combines technology, demographics, and necessity, and that combination doesn't come around often. If you enjoyed this breakdown, make sure you comment below which of these stocks you find most interesting and why. Share this video with someone who's interested in long-term investing and subscribe to Stockora for more deep dives like this. The next big trend is always obvious in hindsight. The goal is to see it before everyone else does. Now, before we move on to the next company, let me know in the comments. Would you personally invest in a market leader like Intuitive Surgical, or do you prefer looking for under-the-radar opportunities with more risk and more upside? Drop your thoughts below, and don't forget to like and share this video if you're finding value so far. It really helps Stockora reach more investors like you.